My neighbor Jessica, she's 29, works as a marketing manager, asked me a question last week that made my skin crawl. Should I wait for the market to crash before I start investing? Here's what terrifies me about that question. Jessica makes $65,000 a year. She's been saying she'll start investing when the timing is right for 3 years now. 3 years of waiting for the perfect moment while inflation ate 6.4% of her purchasing power. That's not strategy. That's your brain lying to you. Look, I made this exact mistake when I was 26. I had $8,000 sitting in a checking account earning basically nothing because I was convinced a recession was coming. I spent 6 months researching the best time to buy while that money lost value every single day. The crash I was waiting for? It never came. At least not when I expected it. But here's the part that really stung. My coworker Mike, same salary, same age, started buying $200 worth of index funds every month during those exact 6 months I was researching. By the time I finally made my first purchase, he was already up on $400. Your brain is wired to keep you alive in a cave, not wealthy in a market. Think about it. For 200,000 years, humans who saw a rustling bush and assumed tiger lived longer than those who assumed wind. Loss aversion kept our ancestors breathing, but that same wiring makes you sell when stocks drop 15% and buy when they're hitting all-time highs. Here's what I mean by that. Researchers at UCLA tracked 78,000 individual investors over 7 years. Want to guess what they found? The average investor underperformed the market by 3.2% annually. Not because they picked bad stocks, because they bought high and sold low, driven by emotions their rational mind couldn't override. 72% of people make their worst financial decisions when they feel most confident about them. Let me tell you about my friend Marcus. He's a brilliant software engineer, makes $140,000 a year, can debug code that would make my head spin. In March 2020, when the market dropped 34% in 5 weeks, he sold everything, every single stock. His reasoning sounded perfectly logical. The world is ending, unemployment is spiking, this is going to get much worse. He felt smart. He felt like he was protecting his family. 18 months later, the market had not only recovered but hit new highs. Marcus had missed an 87% gain from the bottom. That decision cost him $43,000 in unrealized gains. But here's where it gets interesting. Marcus isn't stupid. He's actually brilliant. His brain was doing exactly what it evolved to do, avoid immediate danger at all costs. The problem? Markets aren't saber-toothed tigers. When you see red numbers on a screen, your amygdala fires like you're being chased by a predator. Your heart rate spikes. Your palms sweat. Every instinct screams, run. But running from market volatility is like running from the weather. It's going to happen whether you like it or not. Now, I know what you're thinking. So what am I supposed to do? Ignore my feelings completely? Not exactly. Here's what I learned after losing money to my own emotions more times than I care to admit. Your emotions aren't the problem. Acting on them is. Let me explain with a simple framework I call the 24-hour rule. Whenever I feel a strong urge to buy or sell based on market news, I force myself to wait 24 hours before doing anything. Not 24 hours to research more. Not 24 hours to seek confirmation. Just 24 hours to let the emotional spike pass. You know what happens 90% of the time? The urgency fades. The obvious trade that felt like free money starts looking risky. The panic that made me want to sell everything reveals itself as noise. But there's something even more powerful than managing your emotions. It's understanding why they exist in the first place. Your brain has 2 operating systems. System 1 is fast, automatic, emotional. It sees a 20% market drop and screams, danger. System 2 is slow, deliberate, logical. It knows that 20% drops happen every few years and markets have always recovered. The problem is, System 1 is louder than System 2. Here's a perfect example. During the 2008 financial crisis, Warren Buffett started buying stocks while everyone else was selling. When asked why, he said something that stuck with me. Be fearful when others are greedy, and greedy when others are fearful. That sounds nice in theory, but when your portfolio is down 40% and the news is calling it the worst crisis since the Great Depression, being greedy feels impossible, unless you understand what's really happening in your head. Buffett wasn't ignoring his emotions. He was recognizing them as data, not commands. Fear told him the market was panicked. Panic creates opportunity for people who can stay calm. That mental shift changed everything for me. I started tracking my emotional reactions to market moves. Red day? I'd write down how I felt before checking any news. Green day? Same thing. After 6 months, I noticed a pattern. My gut reactions were wrong 83% of the time. When I felt most confident, I was usually about to make a mistake. When I felt most scared, it was usually the best time to buy. Wild, right? Now here's the framework I use to turn this behavioral liability into an asset. First, automate everything you can. I invest $500 every month automatically, no matter what's happening in the world. My emotions never get a vote on that decision. Second, when you feel a strong urge to make a big move, ask yourself one question. What would someone who owns this company for 20 years do right now? Not someone trading it, someone who owns it. That question cuts through all the noise. A 20-year owner doesn't care about quarterly earnings misses or Fed announcements or Twitter drama. They care about whether the business will be worth more in 2 decades. Third, remember that your brain is trying to protect you from dangers that don't exist anymore. Market volatility feels dangerous, but it's actually where wealth gets created. The average bear market lasts 289 days and loses 35.4%. The average bull market lasts 2.7 years and gains 114%. Your brain fixates on the 289 days of pain and ignores the years of gains that follow. That's why 72% of people never build real wealth. They let their cave brain make their investment decisions. Now, if you're someone who earns a decent living but feels like you're always starting over financially, who researches investments for months without ever buying anything, who sold during the last market drop and regretted it, this is for you. Your brain isn't broken. It's just optimized for the wrong game. The people who build wealth aren't smarter than you. They're not less emotional. They just learn to recognize when their primal wiring is hijacking their financial decisions. Tonight, set up that automatic investment. Even if it's just $50 a month. Even if the market feels scary. Especially then, your future self will thank you for not listening to your caveman brain.